Good day everyone! We are now going to discuss a lesson in general mathematics, which is stocks and bonds. Learning outcomes. At the end of the lesson, the learner is able to illustrate stocks and bonds, distinguish between bonds and stocks. And for our lesson outline, there will be definition of terms related to stocks and definition of terms related to bonds. Stocks. These are shares in the ownership of the company. Owners of stocks may be considered as part owners of the company. There are two types of stocks, common stock and preferred stock. Both will receive dividends or share of earnings of the company. Dividends are paid first to preferred shareholders. Common stock is a security that represents ownership in a corporation. Holders of common stock elect the board of directors and vote on corporate policies. This form of equity ownership typically yields higher rates of return long term. Preferred stock is a different type of equity that represents ownership of a company and the right to claim income from the company's operations. Stocks can be bought or sold at its current price, called the market value. When a person buys some shares, the person receives a certificate with the corporation's name, owner's name, number of shares, and par value per share. Bonds. Simplest term is debt. For certain company to grow some capital, they may purchase a bond. In return for the money lent by the lender, the issuer or debtor will undertake what they will pay the final amount in the interest on a specified future date or when in due. In company's balance sheet, these debts are often called liabilities. While stocks can be offered only to specified corporations, a bond can be issued by any organization, even government bodies or authorities in the sector. Bonds. Bonds are interest-bearing security which promises to pay amount of money on a certain maturity date as stated in the bond certificate. Unlike the stockholders, bondholders are lenders to the institution, which may be a government or private company. Some bond issuers are the national government, government agencies, government-owned and controlled corporations, non-bank corporations, banks, and multilateral agencies. Bondholders do not vote in the institution's annual meeting but the first to claim in the institution's earnings. On the maturity date, the bondholders will receive the face amount of the bond. Aside from the face amount due on the maturity date, the bondholders may receive coupons or payments or interests, usually done semi-annually, depending on the coupon rate stated in the bond certificate. These are the differences between stocks and bonds. Stocks, only issued by corporation. Bonds can be issued by the government and any corporations. Stocks, price that the investors will get will fluctuate depending on the company's performance. The bonds, the price that the lender will get is guaranteed or fixed. In the stocks, have the ownership to the company, while the bonds have the ownership to the company's debt. Markets for stocks and bonds. Stock market. network to operate so that buyers and sellers of stocks can coordinate and connect. Different exchanges that exist today. Number 1, New York Stock Exchange or NYSE, called the Big Board, works on auction-based system. Number 2, American Stock Exchange or Amex, considered one of the most prestigious stock market in the US. They operate on an auction-based system similar to NYSE. National Association of Securities Dealers Automated Quotation or NASDAQ, world's first electronic stock market. Electronic Communications Network or ECN, automated system that buy and sell orders, primarily stocks and currencies. They connect traders and brokerage so that they can trade directly. It grows money by charging a fee for every match or transaction. Definition of terms. Stocks, share in the ownership of a company. Dividend, share in the company's profit. Dividend per share, ratio of the dividends to the number of shares. Stock market, a place where stocks can be bought or sold. The stock market in the Philippines is governed by the Philippine Stock Exchange. Market value, the current price of a stock at which it can be sold. Stock yield ratio, the ratio of the annual dividend per share and the market value per share, also called current stock yield. Par value, the per share amount as stated on the company's certificate. Unlike market value, it is determined by the company and remains stable over time. Example number 1. A certain financial institution declared a 30 million dividend for the common stocks. If there are a total of 700,000 shares of common stock, how much is the dividend per share? Given, total dividend is 30 million. Total shares, 700,000. Find dividend per share. Now, dividend per share is equal to the total dividend over total shares. So that would be 30 million divided by 700,000. You will get 42.86. Therefore, the dividend per share is 42.86 pesos. Example number 2. A certain corporation declared 3% dividend on a stock with a par value of 500 pesos. Mrs. Lingan owns 200 shares of stock with a par value of 500 pesos. How much is the dividend she received? Given, dividend percentage is 3% and the par value is 500 pesos. The number of shares is 200. So let's find the dividend. Solution. The dividend per share is 500 pesos multiplied by 0.03, which is equal to 15 pesos. Since there are 200 shares, the total dividend is 15 pesos per share multiplied by 200 shares. That would be 3,000. In summary, dividend is equal to dividend percentage multiplied by par value multiplied by the number of shares, which is equal to 0.03 multiplied by 500 multiplied by 200, which is equal to 3,000. Thus, the dividend is 3,000 pesos. Example number 3. Corporation A with a current market value of 52 pesos gave a dividend of 8 pesos per share for its common stock. Corporation B, with a current market value of 95 pesos, gave a dividend of 12 pesos per share. Use the stock yield ratio to measure how much dividend shareholders are getting in relation to the amount invested. Solution: given Corporation A dividend per share that is 8 pesos and the market value is 52 pesos. Let's find the stock yield ratio, which is equal to dividend per share divided by the market value. The stock yield ratio is 8 divided by 52, which is equal to 0.1538, which is equal to 15.38%. Now for the Corporation B, dividend per share is equal to 12 pesos and the market value is 95 pesos. Let's find the stock yield ratio, which is equal to dividend per share divided by the market value, which is equal to 12 divided by 95, which is equal to 0.1263, which is equal to 12.63%. Now, Corporation A has a higher stock yield ratio than the Corporation B. Thus, each peso would earn you more if you invest in Corporation A than in Corporation B. If all other things are equal, then it is wiser to invest in Corporation A. Bond market. It is a financial market where debt are issued and traded. Its main goal is to provide a long-term funding for public and private expenditures. This market is classified into three main groups. Issuers sells bonds to their corporation or organization. This group is primarily made up of government sectors, banks, and other major corporations. Underwriter, qualified entities or individual who examine and evaluates a certain financial proposal to assess the advantages or disadvantages involved. Purchasers. Purchasers are the ones who buy the debt or the bond. Theory of efficient markets. It primarily believes that an investor, may that be in a form of an individual or a corporation, will never outdo or beat the performance of the market as a whole. It also believes that the stock's or share's value reflects what the investor know about the stock, and that these investors will not be able to predict the price of the share based on its past performance. Definition of terms in relation to bonds. Bond, interest-bearing security which promises to pay a stated amount of money on the maturity date, and regular interest payments called coupons. Coupon, periodic interest payment that the bondholder receives during the time between purchase date and maturity date, usually received semi-annually. Coupon rate, the rate per coupon payment period denoted by R. Price of a bond, the price of the bond at purchase time denoted by P. Par value or face value, the amount payable on the maturity date denoted by F. If P is equal to F, the bond is purchased at par. If P is less than F, the bond is purchased at a discount. If P is greater than F, the bond is purchased at premium. Term of a bond, fixed amount of time in years at which the bond is redeemable as stated in the bond certificate. Number of years from the time of purchase to maturity date. Fair price of a bond, present value of all cash inflows to the bondholder.